We are joined right now by Bob Pozen. He is chairman of MFS Investment Management. He is the former vice chairman of Fidelity and the author of the book Too Big to Save: How to Fix the U.S. Financial System. Bob, we're so glad to have you here with us in the newsroom. Thanks for joining us. I want to refer to something that Erik and I read this morning that we were talking about. Paul Krugman writing an op-ed in the Times talking about derivative reform and saying instruments like credit default swaps, if they were openly and transparently traded, would that have prevented what we are seeing right now in the SEC's allegations against Goldman Sachs?
I think the disclosure requirements for all mortgage pools could have been a lot better. At the time of these deals, there was only a requirement for aggregate statistics on the pool. I and other people have called for more individual loan statistics, and the SEC within the last few weeks has proposed that. That would give investors a lot more information. As to CDS generally, I think they need a clearing corporation, and that's in the legislation.
Because Krugman argues for blocking creation 100% of CDSs. I mean, is that the right thing to do?
No, I think CDSs are a great innovation. They give people a chance to hedge credit default risk as well as interest rate risk. The problem in credit default swaps was that Congress and the administration in 1999 and 2000 exempted all of these negotiated deals from the SEC and CFTC legislation. What we need is a clearing corporation. We need the short side to put up margin and then for them to be mark-to-market daily. If that happens and we have appropriate disclosure.
People say that's impossible, Bob. You know that. People in the market say mark-to-market daily is impossible.
No, the answer is that's not true. There are, say, 2/3 of all of these financial derivatives which can have a standardized form and can be mark-to-market daily. There are some amount of negotiated customized deals, and what we should have for them is we should have a contingent exemption where we have more capital put up by the financial institutions and we still have some sort of reporting on the pricing. So we can reach a reasonable compromise there.
Bob, you're the chairman of a money management organization with almost $200 billion. In light of what we've heard about Goldman Sachs, in this case, in light of what we've heard about Greece, in light of what we've heard from Lloyd Blankfein over the last several months, is MFS doing any less business with Goldman, or are you inclined on the basis of these things to do less business with Goldman going forward?
I think we continue to do business with Goldman. These are allegations. If the allegations are proved, that's a different story.
But is that to say that if the allegations are proved, you would do less business?
We'd have to see what happens. But you know, this is a specific allegation that there was an affirmative misrepresentation, that there was a neutral and objective choice of these securities, and that really that wasn't true. That's very different than what would apply to most pools.
But is that to say that, in your mind, you've been in this business for a long time, Goldman is the same firm that it was 20 years ago. Goldman is as trustworthy, as easy to deal with, a firm that you can count on as a client, not just as a counterparty, the same way that it was, say, when Sidney Weinberg or Gus Levy was running the firm?
Well, clearly the firm is different than it was as a partnership. But again, I think we really have to see what the facts are that come out. These are allegations, and when we see the facts, then we'll respond to them.
Bob, we thank you so much for your time, for your insights. That is Bob Pozen joining us here in the newsroom.